So how's it going, everyone? Today we're with John Feneck. He's president and CEO of Feneck Consulting, once a senior executive for ETF providers at Merrill Lynch and JP Morgan Chase. Avid follower of the market, in particular gold and silver, I would say would be your expertise. Would you say that that's right? Like gold and silver is your expertise and what you focus on the most, or would you say
I
that,
would
John?
say we're a little different, Tristan, and thanks for having me back.
No worries.
A little different in the sense that, on your show last year, we talked about copper, we talked about palladium, we talked about nickel, lithium. We're agnostic to what kind of mining stock it is. We're much more concerned with percentage return, right? So, like, if we see an opportunity that is in a subsector of commodities that we're, not overly familiar with, we're going to educate ourselves and try to, put that, news out there through our newsletter as well as through our updates that we send to clients.
So would you say more just in general commodities and mining as opposed to like gold and silver?
Yeah, my background is in gold and silver. I started, buying those physical metals in 2000, so 23 years ago. But it has morphed now, pretty much over the last 6, 7 years into, where's the best opportunity for my money at that time. I constantly coach clients, and it's a good idea for your watchers to do this. Is if you've got a finite number of dollars, which pretty much all of us do, you've got to make the best use of those dollars, at all times, right? And so people
Right.
get attached to stocks, they get attached to gold, they get attached to Bitcoin. It's like, hey, what's your best percentage opportunity over the next 1, 3, 6 months? That's kind of how we see the world. We're not trading every 1 or 3 or 6 months, but we're holding core positions that we really have conviction in, and then we are trading on the periphery, right? So that's how we put up a decent returns over the years.
So when you say trading on the periphery, what does that exactly do you mean by trading? Like buying, selling in quick periods of
Mhm.
time? Is that what you mean?
So let's just take gold for an example. We own zero gold. I'm asked gold questions all day long. I don't think that at 1900 and change gold is very interesting to me personally because I, again, as a portfolio manager, want percentage return. I want to buy gold equities that have leverage to the price of that metal, right? So I'm not saying gold's a bad investment. I'm not saying it's not a store of value. Of course it is. For me personally, we have a zero weight there right now. Now we have a nice weighting in silver because silver to me is very undervalued versus gold. If you look at the gold to silver ratio, which is simply dividing the price of gold by the price of silver and coming up with a number, as
Hmm.
that number gets close to 90 plus, that's almost always a buy for silver because it's too far behind the price of gold, if you will. So, we do have a weighting in that commodity. We started to look at natural gas, because I read a commodities newsletter. We're looking at all commodities. So I think that that's something that makes us different, I guess, than some of our competitors that are just focused on the precious metals.
I see. So right now you don't own any actual physical gold. You're focusing more on like gold miners and gold equities. So that would be like gold companies that are actually mining the gold and then selling it. And you talked about leverage, right? So do you see an advantage when they can borrow money to get this gold?
Not leverage in that sense. There's an inherent leverage to something that would be, let's use GDX for an example. It's the largest gold miner ETF out there, right? Every one of those holdings has a different profile. Every one of them are producing gold and sometimes silver and other things, but some of them are hedging production, meaning that they're not fully um, they don't have as much upside to the price of a rise in gold than some of the other holdings may, right? And you have to do that due diligence by looking at each company's website. It's a lot of work, but just know that hedging into the future isn't a bad idea. If you look at the airline industry, what do? They hedge oil all day long, right? They can't be exposed to a huge price spike in oil and not have those hedges in place, right? So what's interesting to me about gold and silver stocks versus oil stocks, or excuse me, airlines, is that these companies are hedging all the time and they're rolling that hedge. Gold and silver companies are kind of like cowboys a lot of times and saying, hey, we want full exposure to a rise in the price of what we're trying to find in the ground. Does that make sense?
So a lot of the time, these gold and silver companies are just fully, they just do gold. They're not hedging at all. Is that what you're saying?
It depends on the company. Some are hedging some of their production forward, but many are just fully exposed, and that can be bad as well, right? Like when silver dropped off a cliff over the last couple of years, many of those silver producers that were not hedging any production really took it on the chin, and you see that in their quarterly earnings, right? You see these massive losses on the silver
Mm.
producers. Now, the
Yeah.
silver explorers and developers, a lot of the companies that you and I have talked about in the past, aren't seeing those losses because they're way in the beginning of what we call the Lassonde curve. They're way back here. They're not near production for another 3 to 5 years most likely. So I think like anything, asset allocation is key, and we we'll buy large cap, mid cap, small cap, gold and silver stocks, but we'll also buy, like we talked about, other things that, companies that try to find lithium, nickel, palladium, etc.
Okay, so what would you say you have major positions in, or not even like positions, but where you sort of leaning more towards, like your favorite sector right now, or your favorite particular gold miners, or what are you liking right now?
Sure. So if we had this conversation before the Silvergate collapse, I would have said that, we're looking at all of the commodities, right? We're looking at copper stocks, nickel stocks, etc. Since that day, which was around March 8th, we have been laser focused on gold and silver stocks pretty much 90% of our day, because gold and silver is what protects in a downturn, not nickel, not copper. Some of these commodities are great buys. But I don't know how this is going to shake out. This financial crisis, I'll call it that because it is literally a soap opera day to day, right? Like we're seeing new news every single day. As you saw this weekend, Credit Suisse went under. Well, I mean, UBS took them out, but took them out for pennies on the dollar, right? And it's interesting to me because UBS and Credit Suisse are the number one and two players in Switzerland, right? That must have been a really interesting conversation over the weekend, because I don't really believe that that's two companies that really like each other very much. So it's weird stuff that's going on, but it's not just one offs like we saw with the '08 crisis, Tristan, and many of your listeners may not have remembered or been old enough to remember, what happened then. But Lehman Brothers happened in '08, and then it was weeks before the next, big name collapsed, right?
Yeah.
This is day after day after day. And we've been talking to clients about this on your show as well as other shows for 3 years now, that when we sat at our computer in March of 2020 and tried to keep up with the pace, I was having a hard time doing that as a professional. So I can only imagine what it's like for a client to keep up with that kind of velocity. And we're seeing some of that play out now since Silvergate, then Silicon Valley, then Signature, et cetera, right? Like this is just a series of missteps, but they're not spacing themselves out by days or weeks. It's literally every other day. It's something is coming, and so we've been really sending a lot of emails to our clients saying, you've got to, this is the time to get laser focused and build that buy list. If you're not buying right now, be ready to go. And that may lead us to our next point here with the Fed, right? Because the Fed's tomorrow. Um, if we had this conversation again pre-Silvergate, there was a chance of a 50 basis point hike in the U.S. because if you remember, Fed Chair Powell was very hawkish. I think that was around March 7th, that Tuesday, and literally the next day, the odds changed to just a quarter point hike. And then by the time Signature collapsed on that Sunday, the following day, we saw a possibility of a pause, meaning no action, no hike, no cut, right? That's pretty dramatic in a matter of maybe 3 business days to go from let's raise to a half to maybe we're not going to raise at all. We've been in the camp all along that they're going to do a quarter point hike. I think that's going to happen tomorrow. If you look at the ECB in Europe last week, they raised 50 basis points. That's showing you that they're not giving up, much ground here. Lagarde has her work cut out for her because Mario Draghi did a lot of unusual things, let's just say, in Europe over his course of his leadership. And that's going to be a problem for European equities, in our view, over the next couple of years. And we don't own any at this moment as a result.
I see. So does it often occur where the ECB has their meeting or their policies done before the Fed? And if so, does the Fed often follow them? How does that work?
The Fed is, to me, the leader globally,
Yeah.
and each region, of course, has to do what they have to do. Right? You're in different points in the cycle, perhaps in Europe than you are in the U.S. I can just say that if the U.S. tomorrow decides to pause, that will be a wake up call for other economies out there, of course, and definitely big news. I know the broad market is hoping for that, of course. It would also be bullish for gold and silver, but I think the Fed is going to have to raise a quarter point because of inflation right now, especially, right? Because since our last appearance, I think inflation's gone from high sixes to exactly 6%, right? Like it hasn't really done much since you and I last talked. I mean, it's gone down, but the Fed's looking for 2%, right? So, I mean, we're not even close. And I don't think we're going to get there because it's just been really persistent. I mean, I've seen it here in gasoline in the States. I mean, it's gasoline has gone up 70 cents in 3 weeks here. And the price of gas itself really isn't escalating. It's very odd. So it's a really tough time for consumers globally right now. I think we've been talking on Kitco since last March and again in June of last year, talking about the possibility of a recession and on your show as well. And now we were calling for summer of this year, right? Last year. And I think that's perfect timing because now the financial crisis is upon us. And I don't know what is going to happen in terms of how fast it comes, but I can say that this action that we're seeing is not normal and it's not good for the broad market participants.
Can we just explain that a bit more? So, what exactly are we calling for? A recession the summer of, what did you
This
say?
year.
This year. So,
Yeah.
I'm not in the USA right now. So, when is that? What month is that? The summer.
So yeah, sorry. Yeah, the summer really starts around early June here,
Okay,
and
June.
ends, call it like Labor Day, like around September, 3rd or whatever that is this year. But somewhere in there has been our time frame, and we've been talking all last year about the Fed pausing somewhere between February and May of this year, which it looks like that may happen at the May meeting, right? So we feel very proud of the fact that we've been, thinking in those terms. We're not proud of the fact that we lost some money last year. I think it's been really hard in the mining space to make any money, and so like years like last year, you just try to survive. But right now, if your listeners are interested in that space, I would encourage them to contact me because this is completely changed as of March 8th with Silvergate's, kicking things off. When you see a financial crisis start off, I mean, it's been 15 years before we've seen any action like this, Tristan. So,
Really? So, you mentioned Silvergate a couple of times. What exactly do you mean by that? I haven't. I'm not. I gotta admit, I'm not an avid follower of sort of gold and silver. So, what is Silvergate?
oh, sorry, yeah, it's just the name of the bank that went under that is a crypto. They had investments in crypto through FTX, which is Sam Bankman-Fried's um, group, and I don't follow crypto, so basically, I can't really speak to all of the inner workings. But for me, as someone who is a portfolio manager, I look at news, I have to act immediately, and I have to get stuff out to my followers, right? So, like the Silvergate stuff to us, we cautioned about many weeks ago because of the connection to FTX. Silicon Valley, I didn't see that coming, and
Hmm.
neither did BlackRock, neither did Jim Cramer. I mean, there are a lot of big names that own positions in Silicon Valley Bank.
Yeah.
So that's what I'm saying, Tristan, is like if you're going to fool BlackRock, the number one asset manager in the world with few trillion under management, then you and I can get fooled. Your clients can get fooled. Everyone can get fooled. I mean, that's serious stuff. So that to me was the biggest wake up call of the group. Um, and yeah, I mean, every day is getting more interesting, right? To see as we look under the hood of these banks, like what kind of other issues exist.
Have you seen much more? I know, I mean, I was doing a little bit of sort of basic research on it, and basically, from what I've seen, they bought a bunch of bonds at low interest rates, and then the Fed started raising rates, so these bonds became worth less and less. Have you seen anything more than that? Anything worse? Like, have they over leveraged in your point, or and also another question is, so since these bank collapses, like, do you still think it's safe to have cash in the bank? And if so, what bank, or would you prefer other assets?
So first question you had about what other things I see. First
Yeah.
Republic Bank has been in the news. That's ticker FRC. It is a yo-yo every single day. I mean, it's all over the place. Even after the good news last week, when we had banks coming to their aid, the stock still declined, I think 30 to 40% by Friday's close. So, this is some serious stuff here. I think you have to watch FRC. I think, companies like not immediately, but companies that could have problems like Wells Fargo, to me, I mean, is something that is the number one bank in the US for mortgage exposure. That definitely helped them on the way up. That's definitely going to hurt them on the way down, right?
Mm.
I don't think that people are really looking that closely at the exposure that a bank like that may have. Plus, they've just been in the headlines for a lot of different reasons that have not been positive over the last few years, as you know. Um, to answer your second question, you have to have some faith in the banks, and I think if you look at the FDIC level, at least in our country, is 250 grand, right? So you know that you're good up to 250K.
Mm.
After that, I don't know, and that's why I personally spread my money out, because I don't want to have that conversation. If you look at what happened with Roku, I don't know if you know ROKU. It's a TV service, big name in tech. They had 26% of their cash in Silicon Valley Bank when the news came out. I'm just like blown away. I mean, I don't know what that number is, but it's got to be a lot of money and clearly above 250 grand. So I'm sure they were really worried about the Fed coming in and having their back, right? There's
Mm.
going to come a time when there isn't anyone having your back, in my opinion. And that's when the wake up call comes globally to say, okay, we're not going to backstop every single bank, and all these, financial institutions have to get their act together. So I think, you know, look, I hope that I'm wrong. I hope that we don't have a recession, obviously, but I do think that it's important that we just tell it like we see it, because clients need to prepare for that, right? If you're approaching a recession and you've got concerns about the banking crisis and you got a little money in crypto, which is all over the map, I mean, your life financially is becoming more unstable, right?
Yes. So when you say you spread your money across a range of assets, what is the sort of, what are the assets, and what around are the sort of percentages when the way you spread your risk across assets?
Sure. This is just off the top of my head. I don't have a spreadsheet or anything,
Yeah.
but most of my money is in mining, and metals.
Or
That's
even
my primary. Yeah.
mining the metal. I mean,
Um,
or even just for, like, let's say your clients or just regular people, what's the sort of good asset allocation?
yeah, that's impossible for me to answer. It's a great question, but I don't know any of your listeners, or if they need to buy a boat, or they're getting married, or like what their risk tolerance is. Like, the idea is try to partner with a financial advisor in your local market that can actually return your calls and emails, because that's going to be key as we move forward, right? If you have, and I hate to say this, but if you have under a certain dollar amount, these bigger companies will tier you, meaning if you have 250K or more, you're in this tier, 500K, you're in this tier, a million or more, you're in this tier, 5 million or more, you're in that tier. And the
Mm.
service will increase as you have more money with them, right? So you have to do that due diligence with someone and ask them straight out,
True.
you know, do you have the ability to call me and email me, or am I going to speak to some assistant who's got hardly any market experience and has never seen a crisis like 0809, right? Like
Mm.
that's not cool. So
Yeah, for
if you
sure. When you
strike out
got
with the
smaller amounts of money, a lot of the time you don't matter as much, especially to the big corporations.
I wish that that was not true, but it's absolutely true. That's where I
Yeah,
spent most of
true.
my career is in financial, advisory and worked at these bigger shops. And it is absolutely true. In fact, some of the bigger shops don't even pay advisors anymore on smaller accounts. So it makes them really incentivized to work with larger clients, which
Mm.
is unfair to some of the smaller clients, which is why a lot of people will work with someone like me or some other people like me to give them some idea. There's a lot of people right now, Tristan, that do things themselves, right? I firmly believe that. If you look at how the business is shifting, it's not, let me get an advisor for everything that I do. Let me have an advisor for some of what I do. And then let's play with some Bitcoin money. Let's play with some mining money. Let's play with some tech money, right? Let's buy a house over here as a rental property. There's people doing stuff that doesn't have to be like around that financial advisory relationship, in my view. But look, I think it's incredibly important for people to partner with someone right now because, as we've said on your show before, free advice is just that, it's free. I mean, Jim Cramer was out there, not to go after Jim, but on February 8th, talking up Silicon Valley Bank as a buy. I mean, here we are, six weeks fast forward, and has he told you to sell? Like, did he call you and say, "Hey, Tristan, gotta get out of this thing"? Like, there's no there's just it's free. You can turn on CNBC and watch Jim for the last 20 plus years, and he's done a great job in a lot of different respects. But he also doesn't know anything about you or your risk tolerance or your personal situation. So I always tell people that I just watch TV or read a paper that you got to do more than that. You got to do more homework because this is go time. It's like when you see banks fail like this, you got to get more interested.
Mm. Oh yeah, the thing with a lot of the TV, the article writers, the newspapers, or even YouTubers, you have to realize that their incentive is to make content and to make content generally about the more exciting things. And so yeah, their incentive isn't necessarily to make you as much as money as possible, or to even look at like, let's say, the stocks that are going to do as well over the next sort of 5-10 years. Their incentive is mainly to produce content that's going to get as much views as possible. So yeah, everyone watching needs to at least be aware of what is the incentive of each bit of content that they're watching, whether that is CNBC or on TV or on YouTube or article writers. So yeah, finding an advisor where their incentives are aligned with yours is very important. Someone that you trust. Do you do broad financial advice, or do people just go to you mainly for gold, silver, etc., commodities?
I have a service helping people with the macro news and kind of sifting through that. For example, when the Fed comes out, I will tell people what happened, but then also how it would impact the broad market, how that might impact energy, how it might impact mining. When GDP comes out, same thing. When non-farm payrolls comes out, same thing. So I'm kind of showing people along the way, you know, this is important, that's important, that's important. And it really helps people. They don't need to work with me for like years, right? They can work with me for a few months and understand kind of, okay, these are the things I need to start looking for more often. Obviously, CPI is the biggest one that comes to mind in recent months, right? Where that number can drive markets for days, a big miss or a big decline. And unfortunately, we haven't seen too many big declines. So it's something that is yeah, I don't help like people buy, sell, hold, if that's what you mean. And I don't manage their money, but I basically will try to, look at their personal situation, refer them to an advisor if I can, do whatever I can to help them with their situation. But I'll tell you what, up until March 8th, I was doing a lot of hand holding, right? Because there's a lot of people that lost money in the sector over the last year or two. And they're wondering, will gold and silver ever come around? And now that answer is yes.
Do you think for the long term, or is that more just 2023 play?
I would say that you're going to get a sustained run here. To me, long term is different probably than your long term because I'm looking at a screen all day and there's hardly anything that you can put away for 5 or 10 years anymore, right? I mean, I think, over the next 1 to 2 years, you've got a nice run here, not only because of the banks in the near term, but also because we were talking recession before the banks, right? Like, I mean, this was a very real possibility before that. And I think that's only going to exacerbate the situation.
I see. So where can people find you if they want to, if they have questions, if they want to learn more,
Yeah,
or
sure. It's just fennecconsulting.com. My personal email is john.feneck@yahoo.com. We'll have some notes for people in the show notes, I would hope. And, if people have questions, we've got a commodities newsletter. That's where a lot of people start. And then if they want to graduate to something else, that's something that we offer. But yeah, I think it's time to do your research, especially in gold and gold and silver related stuff. That if you look at the price of gold, look at the ETF GLD, and look how well it's done since March 8th or 9th, right? I mean, it's been a really beautiful move on high volume. And that's something that is directly related to the financial crisis that's unfolding.
okay. Well, thank you very much for coming on, John. Appreciate
Of
it.
course, Tristan.
Okay.
Thank you.
Cheers. Bye.